Asher Fried here with Offset Gains Consulting. Just wanted to go over this, see if you are taking the right or the correct amount of depreciation off of your rental properties and maximizing your leverage and paying a lot less taxes. All right. If you purchase a real estate investment property, if you don't do anything, you're going to be taking off 27 and a half years. So how do you know what your property is doing? You could ask your accountant to provide you with this document. It's the Depreciation Detail Listing Form 8825. Each one of your properties should have a document that looks like this. It's not filed with the return, so you're not going to necessarily have it in your tax returns, but each property, each LLC should have this with all the properties in that LLC. What you have here is three listings. There's the purchase, there's the renovation, and then there's the land. When you purchase a property, for whatever you purchase, some of it goes to land, and that's not depreciable. If you follow this line, you'll see zero. But what's left over after the land, you do get to depreciate. This is a multifamily, so it's going to be 27 and a half years if you don't do a quasi. So you could see that right here. Life use is 27.5. That's standard depreciation, and you're going to end up with $78,375 worth of depreciation per year. This is the first year, wasn't a full year, so that's why it's only 55,526. But every year will be 78,375. Now we did a cost seg on this property, and we got him north of $500,000 worth of faster depreciating assets. It was a 100% bonus for 2022, and at this point, at the end of 2023, he had only taken off 133,000. We had calculated that by the end of 2024, with our cost seg, he should have been taking north of like 650, 670. So in 2024, he gets to take the difference of 650 and 133, whatever it was. It could be that it was a little higher than that. And for 2024, he's going to have $500,000 to $600,000 worth of depreciation. He needed it this year. That's why it worked for him. So this is just a way for you to tell like what's going on here, and for you to bring it up with your CPA. Ask him, do you want your properties all to be going on 27 and a half years? Maybe there's certain properties that make sense to break them out into 15 and 5 years. You get more depreciation. And if you need it this year, definitely worth looking into. That's it for today. Hope this was helpful and you learned something.